Also with us is Joseph Quinlan. He is the chief market strategist at U.S. Trust Bank of America Private Wealth Management. He recently forecast the S&P to rise to 1250. He is also the author of Deep Integration: How Transatlantic Markets Are Leading Globalization. Let's start with you, Joe. I wonder, we've been talking a lot about what's going to be the catalyst for this economy, what's going to be the catalyst for this market, and a lot of times it just keeps coming back to lending. There's a problem with lending to small businesses. There's a problem with lending to consumers. Is that a concern for you?
Yeah, we're watching it very closely, Matt, but I think the corporate America has a lot of cash on its balance sheet. So you're going to see more M&A deals you were just talking about. You're going to see more hiring, more capital expenditures. So we have the cash to drive growth. I think the lending will come in the second half of this year and in 2011. It'll come.
Hey, Joe, what's going to get it happening, though? Because, I've talked to folks down on Wall Street, and they say they're willing to lend, but companies aren't interested right now.
Yeah, Carol, it's amazing. A year ago, we didn't want to lend basically to financial institutions. This year, we do want to lend, but no one wants to take our money, at least the folks who have cash. So I think, we have this standoff, but I do think as the economy improves, as the confidence comes back, as the uncertainty is taken out of the markets and the economy, then you're going to start to see lending start to normalize. We're not there. That's probably a story for 2011.
Does that help the housing market then? Does that help us bounce off the bottom of this housing market?
Man, I think it makes it less worse. I don't think we see a double dip or a triple dip, whatever you want to call it, the housing. The housing itself, it's very spotty. Certain markets in the United States are very robust. Others are going to continue to lag.
Hey, Joe, it's Adam. Tier 1 capital ratios at the banks literally double in some cases what they were a year ago. I mean, are the banks really willing to lend? They're kind of worried, right? They're keeping money on the balance sheet.
Yeah, those regulations are going to keep some more money on our balance sheet, but I think the hit will be overseas. I think a lot of banks, big banks here in the United States, they're going to become more domestic and less global. That's my biggest fear, that the money stays home instead of going overseas where there's some good opportunities.
We have Zahra Burton at the New York Stock Exchange. We're going to check in with her in just a little bit, but we still have Joe standing by as well as the Markets Roundtable. And John, let me get your take on this market here, because we've seen low volume on the up days and heavier volume on the down days. Not a lot of change here today, but what do you think retail investors need to see to get back in?
One of the things that retail investors need to see to get back in is make sure that this rally is for real. The S&P 500 has actually rallied more than 11% in July, and largely the game changer has been extending the unemployment benefits on July 20th. The S&P 500 was down around 1050 on that morning that the legislators signed that bill into law and extending them out to November. So I think that once we have some of the weak data that's coming out in the first half of August, we get that behind us, and the stock market should move nicely forward.
Hey, John, it's Dominic here. How important, and I'm not the biggest technician or chart watcher here, but it seems like we just want to keep on bumping up into this 200-day or longer-term moving average, this 200-day moving average. It's at 1113, and go figure we close at 1113 today. How important is that for the market right now?
Well, one thing I don't watch is the 200-day moving average. That's what by default everybody looks at those 50 days and 200-day moving averages. For me, that's not the real indication. What I'm trying to measure right now is investor confidence, and what I'm seeing is investor confidence is coming back into the market in July after extending the unemployment benefits. And I think once we get the investor confidence might be a little bit ahead of itself here right now. So I'm looking for some economic data to miss economist expectations on Friday and on Monday and on Friday of next week.
Right.
And I think that's going to soften up the market.
Consumers may not be too confident, guys, but I'm looking at these earnings coming out from Norfolk Southern, Julie, and obviously they feel confident enough that they're boosting their dividend.
That's right. Yet another transportation company coming out with earnings and beating estimates. And as you said, boosting the dividend as well to 36 cents from 34 cents. Let's talk about the earnings here. The company did see a pretty big increase in earnings year over year of about 59%. On a per share basis, we're talking about $1.04. Mm-hmm. The average analyst estimate was 98.99 cents. Revenue's just about in line here. And the company's saying that its margins looked, what it says, are relatively strong. Operating ratio improving by 5 percentage points to 69.8%. They say that's a second quarter record, I should say. The CEO, Wick Moorman, saying in this statement here that it's the fourth straight quarter of volume growth. So he's talking about still volume is growing.
That's
People
good
are
to
still
see.
shipping things. He also says we're optimistic about continued year-over-year increases in rail traffic. So that's telling as well. I'm also looking at what they're moving around the country. First of all, general merchandise revenues, 31% increase here. Coal revenues up 36%, and intermodal, when they use different, not just trains, but using different ways to get things around the country, 23% increase. So it looks like everything that they're moving around,
right,
the volumes are going up, and therefore the revenues are going up for Norfolk Southern.
Joe Quinlan, let me bring you into this, because a lot of those transportation companies, UPS, FedEx, and now Norfolk Southern, I mean, we are seeing some upbeat news from them. That's a good sign, or is it in your view?
No, it's a very good sign, Carol. The products are moving, people are buying, they're selling. A lot of the stuff is going for exports as well. So, I mean, this is the backbone of the economy, and it's showing some strength here. So I'm very encouraged by that.
Hey, Joe, it's Julie here. But, we keep seeing these earnings numbers that seem to signify that the economy is back on track. You have these Norfolk Southern numbers. You had FedEx, and yet then you have that consumer confidence number today. So what's going on here? We keep talking about this disconnect.
Yeah, I think the consumer confidence, Julie, maybe that was related to the Gulf oil spill. It really got depressing in July watching that video camera. And I know the consumer's worried about employment here, but I think the corporate side of the equation is gaining some strength, as we just saw. That will pull the consumer later. This is not a consumption-led recovery. It's corporate-led.
But you know what? That's not going to help the jobs picture, is it? I mean, John, let me get your take on this. We keep seeing better earnings. There have been positive data points coming out, and yet unemployment still hovering near 10%. I mean, do we just need to get used to this? Is it going to pull us down again? It can't be healthy to have 9.7% unemployment and have that continue to go on.
No, it certainly can't. But we had some encouraging signs in today's Richmond Fed survey. The unemployment index within that survey jumped 6 points, and they've jumped 4 months consecutively in a row. So it looks like in some sectors of the economy, we're starting to see some job growth coming into the marketplace.
Yeah, but guys, does it need to be juiced a little bit? Joe, we've got the mayor of Philadelphia coming on shortly, and he's down in Washington. He's asking for a jobs bill. Do we need something like that to finally really get this economy back on track?
The biggest issue is simply this. Amongst the college-educated workers with 4-year degrees, skilled labor, the unemployment rate's 4.4%. It's 4.4%. At the other end of the scale, you've got 40% of our labor market that has a high school degree or less. They are untrained. They need to be retrained for the 21st century economy. That's the big disconnect.
And what about, we talk about help for workers. You guys we were talking about lending before and to some of those big companies, but I've got a viewer emailing me and says it's not fortune companies are not borrowing. Banks still need to lend to small business. I mean, we talk about how important the small businessman is to this economy, really kind of the backbone here. John, that's another thing. Do we need to really provide more assistance to those small businesses out there?
Oh, we certainly do. We see the small business index over the last 2-3 months really starting to erode. So the confidence of small business owners is waning, and we'd like to see that start to level out and to start to move higher. But we're not seeing an indication of that yet.
It also, it brings to mind Andy Grove's column in Business Week a couple of months ago, where he said basically we're priced out of the jobs market globally. It doesn't matter how many new small businesses come along. We can have as many entrepreneurs as we want. We're not going to get back to the time where we're producing stuff in this country because it's so cheap to do it elsewhere. I mean, we could talk about it obviously for hours, but Joe, is this really... Do you think it's a huge structural problem for the markets and for the economy?
Matt, maybe we're too productive. Maybe we make too many things with too less people. I don't think we're priced out of the markets. I think the U.S. companies are extremely productive. We've just got to bring along the small businesses, get them into the fold. That's probably a story for early 2011. But the big guys got to get going, and they are, and they'll drag along the rest.
John, it's Dominic here. I mean, Mohamed Al-Arian over at PIMCO is with Tom Keene on Bloomberg this morning here, talking about this idea that earnings are a backward-looking indicator and that jobs really are the concern here. So if it really is a situation where earnings are backward-looking, what exactly is going to tell us that the earnings can be something that we can hang our hats on for forward-looking, momentum here?
Well, I think you're going to see it in the surveys that we had from the Richmond survey. You're starting to see manufacturing doing some hiring, and we're going to be looking for small businesses as the lending starts to come in. We're going to expect that small businesses will do some more hiring, and some of these larger firms that have got a lot of temps on their things that will convert those into full-time employment jobs.
Dov, I'm glad you brought up Mohamed Al-Arian. We actually have a little bit more of that interview, and I want to bring it to our viewers. He's got a pretty dim outlook on the economy. Everybody, listen in.
The indicators we look at, and I know there's disagreement on this, but the indicators that we look at suggest that the economy continues to lose momentum.
You know, Joe, he doesn't sound very upbeat. You sound a little bit more upbeat there. I mean, do you think he's wrong or what?
No, I agree with him in a sense. The economy's lost some momentum, but I think we're leveling out. And so there's a difference there. And I would go back to that earlier comment. I mean, earnings are backward looking, but the guidance this season has been very good. That's a forward-looking indicator. A lot of the guidance from IT, the industrials, materials, energy, it's been very positive, more positive than I expected. So there's your benchmark for future growth.
Well, Joe, at the end of the day, we all have to make the decision. Do we put more capital to work today? And is the answer yes?
Yes, in large cap U.S. companies, yes.
But wait.
I want to jump.
Go ahead, Matt.
I want to jump in. I just want to jump in here because Broadcom has come out. Julie points that out. You know, it's a $20 billion company, and it's one of those companies that created a lot of jobs. Jules, what do the numbers look like?
Well, the numbers actually, Matt, coming in for Broadcom, it looks like the company, it's sort of a mixed picture, if you will, coming in on Broadcom, because the company, on the one hand, reporting earnings per share, it looks like that are short of estimates. At the same time, revenues in line with estimates, and the third quarter forecast is above what the street had been looking for.
All right, but we've got the stock taking a hit in the after hours. All right, guys, we've got to run. We've got to say goodbye to our guests, John Bougearel of Structural Logic and Joe Quinlan of U.S. Trust Bank of America Private Wealth Management. Guys, thank you so much for walking us through the close on this Tuesday.